You're about to listen to the Yet Another Value podcast with your host, me, Andrew Walker. Today is a kind of special episode. I have my friend Artem Fokin back on the podcast. Artem is one of the most frequent and popular guests on the podcast. He's come on 7 or 8 times, and we do something different. We don't talk about a individual specific stock. This is just Artem and I coming on and kind of rambling for about an hour, over an hour, about process improvements, things we're thinking about, ways we've tried to improve as investors over the past 10 years, all sorts of stuff. We start touching on AI and expert calls a little bit. This podcast is going to be sponsored by AlphaSense. We actually are doing a separate webinar talking specifically about process improvements in AI and expert calls that I'll include a link in the show notes and talk about more throughout the podcast and stuff. But I think, investing it's a mental sport. To Artem and I know it's a craft. We're always thinking about how to improve, all that sort of stuff. So I think you're going to really enjoy this conversation about just Artem and I talking about ways we can improve, ways we think about investing, all that sort of stuff. So it's a little bit different, but I think you're really going to enjoy it. I had a really, really fun time recording this. So we're going to get there in one second. But first, a word from our sponsors. Today's podcast is sponsored by AlphaSense. Look, AlphaSense and Tegas are two of my longest time subscriptions. They're two of the podcast's longest time sponsorships. I love them both, and I'm so glad they merged. The product is awesome. I've done so much work with them. I consider it definitely the most valuable subscription I've got. Between AlphaSense burgeoning AI tools, they're getting better every month, and particularly the expert library on both of them. Look, I'll give you a little secret. I'm always pushing myself to be a better investor, and one of the ways I'm trying to do that is I've pushed myself to once a week, I do an expert call on a company or sector that I'm researching, come rain or shine. And it's just a really interesting way to be tapping into new ideas, people who are actually operating, get out of the spreadsheets, get out of the SEC filings, and actually talk to somebody about what's going on in industry. I do that myself, out of pocket. AlphaSense doesn't pay, Tegas doesn't pay. That's just me. But I mentioned that because look, I think it's really continuing to help improve me as an investor. You'll notice it in the podcast when I talk to people. I do expert calls on the companies we're going to discuss, and I just show it like I get real value out of it. And if you're a fundamental investor interested in learning more, diving deeper, I think you will too. So Tegas AlphaSense, I love the product. They've been a long time sponsor, and I'm happy to keep having them on the podcast. All right, hello, and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. With me today, I'm excited to have on one of my best friends in the industry, one of my favorite guests, Artem Fokin. Artem, how's it going?
Hi, Andrew. Great seeing you. I was actually thinking about wearing the same polo, Yet Another Value podcast today for the recording, but I decided that maybe it will be one too many. So I figured out you will be exclusively wearing this.
Well, is it because I told you last night I was going to wear this, and then you said I might wear my famous pink polo to go with it?
I think you often wear that for recordings.
Sometimes. But we've got a lot to talk about today. Let's just start before we get there. Quick disclaimer, nothing on this podcast investing advice. Full disclaimer always at the end. And I'll just roll it into, look, add to disclaimer, Artem and I are kind of doing a different podcast here. We are Artem's one of the most popular guests. I believe it's his 7th or 8th time on the podcast. We did a podcast earlier this year that got a lot of great feedback where Artem and I interviewed him as one of the keynotes at Planet Microcap. We're doing this podcast, and then I think we're going to do a follow-on webinar with AlphaSense talking about using AI and expert calls in investing. So I'll include a link to that in the show notes. But this podcast, we're just taking a step back, no real individual securities, and just talking about the investing process, things we learned about, things that Artem and I talk about while I walk my dog Penny, 2 or 3 nights a week, every week. So that's the overall feel of this process. Artem, anything you want to add before I kind of jump into a first question and we just start basically rambling for an hour, or knowing you 3 hours?
Yeah, knowing me and you, it will be not an hour. It will probably run longer. Yes, I think if I were to ask to summarize the theme, the topic, the subject of today's podcast, I would call it perfecting the craft.
Yes.
Investing is a craft.
Yes.
It's a profession. It's a craft. And we as craftsmen would like to improve. And you reach that improvement through iteration, through feedback loops, through talking with other people in the field and getting their feedback on your own process of conducting that craft, and sometimes cloning or stealing their ideas. I'm not talking about stock ideas. I'm talking about process ideas, how to play this game at a better level.
Artem, it's like you're in my head. So I've got a post. It's in draft. I'm going to put it up at some point. But if I can ramble for a second, the post is all about, as you know, I ran a high rocks race recently, right? And when you run any type of race, it's kind of really clear who's better than you, right? You run, and if they cross the finish line in a time that's faster than you, they're better. And one of the interesting things in all sports, when you train hard and you run a race and then you see someone runs it faster, psychologically, you know that barrier can be broken and you can push yourself harder and beat it. The most famous example is Roger Bannister, right? He runs the 4-minute mile and people think it's physically impossible. 2 months later, someone else runs a 4-minute mile. Now, good high schoolers will run 4-minute miles, you know? And I always think about that, like in investing, what is the thing that pushes you harder? Like, I'm sure all of us are internally driven, competitive people. What is the thing that pushes you harder? I will tell you what it's not. It is not, hey, investor A generated 300% returns last year. I generated 4% returns. They're so much better than me. I need to push harder, because that has no context. They might have just YOLO'd call options. For me, what it often is for me, if I can try to land this plane, is when I talk to people like you and I say, hey, Artem, walk me through this thesis. And you say, oh, yeah, as part of this thesis, I did 5 expert calls on Tegas, and one of them uncovered this nugget that no one knew, and it sent me on this rabbit hole. It's when I hear someone and they did great research, and I'm like, oh, I wish I had that insight into an idea I had, or I wish I had that in the ideas I had. That's kind of what pushes me, and that's like kind of the process improvement for me. And there's lots of other things, but I've kind of rambled. Hopefully I nailed that plane. You can just respond or tell me if you agree with that.
That's interesting. For me, great investor track records do actually motivate and inspire me. But I'm not talking about a single year. I'm talking about an extended period of time with very strong returns over that period. For example, if someone did 25% CAGR for 20 years, they're probably one of the best in this profession that ever lived, especially if they do something similar conceptually to the style investment I practice. In other words, if it's Renaissance technologies with medallion fund, sure, they play different game. It's not what I do. It's not what I know how to do, and will probably never know how to do. So that is not that inspiration for me. I'm intellectually curious about how they did it, but it's not something that will be inspiration for me. If you pick someone, let's pick a great investor, David Tepper, who supposedly, based on publicly available information, had a fantastic track record for many, many years. That is inspiration. Or Joel Greenblatt, his track record, or part of that, I think, is published at the back cover or back cover of the book You Can Be Stock Market Genius. That's inspiration. So single years, probably not inspirational for me, probably will not push me work harder or think differently, but they will probably inspire me in the longer term. So sure.
Can I ask you a question on that?
Yeah.
So I generally agree with you, but I've gone a little bit back and forth on this, and I'll tell you why. I was talking to someone with a very good track record. I mean, borderline elite track record, who runs it very diversified. You know, they're running like 30 to 50 positions plus long shorts. They're running diversified, lower nets, all this. And I was talking to them about someone who's got a great track record, right? 14 years, super concentrated, very good track record. I was like, hey, and they said, look, I've talked to this person. I've interacted with them. I'm very skeptical that this person is a good investor. I was like, oh, well, track record, you know, like scoreboard, bro. They're like, look, this person runs concentrated. Over the 14 years, they've had 10 positions, right? You don't have statistical significance. They literally could be the famous monkey that flipped a coin and one of the coins came up very heads, right? Like if 10 years ago you had plowed into Tesla, your returns would be incredible. I don't know if there's skill there or not. Now, you know, again, stock price, bro, like scoreboard, bro, but is that statistically significant? Like 10 years and in a concentrated fund, it's not a lot of investments. I think the person is clearly wrong, but the person who said, hey, Warren Buffett still doesn't have enough investments to be statistically significant. I think that's wrong, like 50 years. But I do hear if somebody started in 2012 and invested today, if they had bought Mag 7, they basically would be a legendary investor. And I'm not sure. Like, hey, they had the insight to buy Max 7. Should we give them credit as a legendary investor or not? I don't know, but I've come to be a little bit of skeptical. And part of that might be because, you see some, I read all these business books, me and Bern Hobart on our book discussions, and it's like a little bit of a running joke. Everyone you read, the person had a near-death experience. And you're like, they created incredible returns, but any return stream times zero is zero. And like in the first 10 to 12 years of their return stream, there was this thing where like, if things had broken just a little worse for them, it would have been a zero. And so again, throw a lot out there, but I've gotten just a little more skeptical of even like longer term track records based on that. How do you think about that?
I don't think this question is answerable. Meaning we cannot, through deduction or induction, or inference, we cannot get to a conclusion that we would feel 95% confident that it's an accurate conclusion. I don't think it's an answerable question. It's almost a question of belief. Do you believe in XYZ or you don't believe in XYZ? Now, if you believe in Santa Claus, probably it's a little too much. But there are other things that are issues of faith, of belief, that people do not need proof. So to answer this question, and remember, I don't know the fund you're talking about. I don't know the fund who is a person who is skeptical. I don't know the person who delivered those returns. So I have literally as much information as anybody who is listening to this podcast right now. So I don't know. My logic is, what I'm thinking is this. Very often, when people say, John, and this is hypothetical John, so if any Johns in our network, we're not talking about you. John is a great investor. What it means more often than not is that the speaker and John are fairly similar in their thought process. And the speaker, thinking of himself that all of us are above average drivers and all of us are above average investors and above average runners and swimmers, even if you don't know how to swim. So that was a joke, Andrew. So
I was laughing because in college I was like, I'm an above average swimmer, and then I hopped in a pool. I was like, oh, I barely know how to swim.
So, and what it means is that it's a similar to me bias at play. And when that person means Bob, again, hypothetical Bob, who does something different, and the person does not fully understand Bob's style or Bob's thought process or decision-making, they think that they're not a good investor, even if their track record may indicate otherwise. I'm not dismissing your argument that it's maybe not statistically significant. I get it, but that is not answerable. I'm just sharing how I view it. And as I said, I cannot prove that my way of thinking about it is right, but I think that it works for me. For example, some people are superior business analysts. They're just fantastic. They're at the top. Sometimes that translates into money making. Sometimes it doesn't. Some people are really good at idea generation. They may be not as good at actual doing analysis, but because they're capable of finding great ideas, they make money. There will be people who are really good at risk management. And that's how they make money. There will be people who just have, and that's the one that I understand the least about, but I have some people in my network who I think have this incredible money smell. And I talk to them about the position, and I think that they don't know this position as well as I do, even though I don't own it. But that person still makes money. They do some analysis, and I'm not saying they are bad. I'm saying that that's not where they make money. But there's something else about them, about their psyche, about their process thinking. I don't know. But they make money. They have the money smell. And remember, I come up with the term money smell because I cannot come up with anything better. So in my if I were assigning probability, my base case would be your friend who did not acknowledge the returns being deserved by another friend of yours. My guess is that they're just very different. Remember you and I, when we were in Vegas at Planet Microcap, we spoke about the superpower. Different people have different superpowers. And I think it's very important to have in your network people with different superpowers. And also just for people who don't listen to everything that Andrew and I talk about, the way I define superpower doesn't mean that you're the best at certain skill in the world. It means that it's your relative strengths. Meaning, Andrew is probably better at lifting weights than running, or as we found out right now, swimming. So in exercise, weightlifting will be Andrew's superpower. In investing, different people have different relative strengths, and that will be their relative superpower. So that's just definition. So I suspect that those two people you spoke about, they have different superpowers. That's why, and they don't recognize that, or at least one of them doesn't recognize that. As a result, he doesn't speak that highly of the investment talent and acumen of the person with very enviable, very impressive track record. That's my best guess.
No, look, I think you're right. Let me just propose one more hypothetical. And I'm laughing so hard because you and I were like, hey, it's just Artem and Andrew rambling. Let's kick off with, we've got this buzzy, like ESPN would lead it with first take question that we're going to get to in a second, but we said we were going to kick off with that. And then we got into a conversation on statistical significance of investor returns. Let me just ask one follow-up question. Somebody who bought Bitcoin 10 years ago and held it till today, I don't think it's crazy to say they have better returns than every investor that we know, right? Bitcoin 10 years ago was 200, and as you and I are talking, it's $115,000, right? So in 10 years, they've got, what is that, a 500 plus X backer, right? If they bought in any size, they've got just absolute groundbreaking returns. Is somebody who bought Bitcoin 10 years ago and rode it till today, are they a great investor? Because their returns would say that they are literally the best investor of all time.
I would say that there is a very high probability that such person is a great asset allocator, which is different than an investor. That's number one. Number two, if that person, and the answer I think will be very context specific. If that person in 2012 had $3 million net worth and they put 2.8 million into Bitcoin, I would say, boy, Russian roulette also statistically works, but it's a dumb idea to play it. However, if that person with the same 3 million net worth in our example, and by the way, let's imagine also that the person is 30 years old, healthy, has a good professional career, etc., etc. If the same person put even 10%, $300,000 in our example, into same Bitcoin in 2012, I would say they're probably a great asset allocator. And I would also say that they may be good. And I'm saying maybe because here we're speaking about significant statistical sample of one in your example. They're probably good or even incredibly good at envisioning different future states of the world. And one of those potential future states did play out, and it played out in an incredibly favorable manner.
No, look, I hear you. I've been working with a coach, and one of the things they keep telling me is, Andrew, you want a definitive answer to all these questions, and there are no definitive answers. Like, that's one of the, I suppose it's the beauty of investing. It's the art of investing. But the logical side of me, I want to read a story and I want to know the ending. And like with investing, there is no right answer unless kind of your Renaissance technology and you run 1,000 trades per day, and then you can find statistically significant ones. But like I described the Bitcoin thing, they were kind of a VC and they were right, and it's scoreboard, bro, but it's tough. Okay. Anything else there? Because I want to get to our first take question.
Okay, before you get into what you wanted to ask me, and somehow 20 minutes later, you still haven't asked me, or 15. So I would also say, when you mentioned that your coach told you, like, oh, Andrew, you want to know the definitive answers to questions that are not, that don't have such answer, I would make things even more complicated. Because very often, if you are investing in companies that commonly called compounders. So I will try to maybe narrow the definition a little bit. company with attractive unit economics, with a long growth runway, executing that runway and doing it in a very good way because it has strong management that can get execution done. So again, I'm not saying that this is classic definition, I'm just oversimplifying here. You are statistically betting on outliers. Meaning most companies will not deliver, let's say, 10 years of 20% revenue growth, right? Or 20% of earnings growth. You pick the numbers. Statistically, it's not going to happen. So you are betting on outliers, which means that your base rates, if you just take all universe of stocks, will be against you. Now, if you start cutting and recutting that universe, and I'm making this criteria up, okay? So I'm not saying that this is a good criteria. If you say, I want a fund owner operator with at least 20% stake, and I want companies that pick margins, pick revenue growth, pick ROIC, pick they got backed by Sequoia or Anderson Horowitz or any other great VC that you think are great investors, whatever your universe is. In that case, you may be churning base rates in your favor. But even with those, I'm not sure they will be massively in your favor. So you definitionally from the beginning cannot get a definitive answer. And if you get somewhat definitive answer, somewhat definitive in quotes right now, then your base rates are against you. You're betting on outliers in this example, in this style.
Look, that's a really fascinating way to frame it. I love the Warren Buffett had the example once where he had like a University of Chicago expert who said, "Oh, Berkshire, there are 3 standard deviation outlier, there are 4 standard deviation outlier, there are 5 standard deviation outlier," and then eventually the economist just put his money in Berkshire, invested in Berkshire, and like what you're kind of describing is, hey, an investor, when you're betting on these great compounders, the average company, what is the stat? Like 80% of the market's returns have been, it's not the 80-20 rule in terms of 80% of the market returns are driven by 20% of the stock. It's like 80% of the market's returns are driven by like 20 stocks or something over the very long run. I'm a little bit exaggerating.
It was a famous academic paper published several years ago by professor, I forgot his name. I think he's from Texas, but I can be wrong. And it was like 4% of stocks.
Yes, it was
4% of return, etc. There is this.
I think there was some survivorship bias there and stuff, but the point was taken. But I love what you're saying. The compounders are like, you're betting on a company being one of those 4%, right? You're betting against base rates. It's a really interesting way to frame it.
But another thing that comes here is that, and by the way, to defend that professor, is that any paper of this nature will have some limitations. It's probably impossible to make it perfect. And obviously, many people will say, oh, you miss this, you miss that. Sure. We're talking about here 80-20 rule, meaning the intellectual 80-20 rule. Do you get 80% of the insights, even if 20% of situations are not covered? So, but and since we got into this topic completely unexpectedly. So if you think about, if you say, I am betting on statistically less likely events from the base rate perspective. So probabilities, if you do a random darts throwing, are against you. So number one, you need to figure out how to improve the probabilities. Sure, that's obvious. But number two, you need to have, I think many investors call it convexity. I don't know whether mathematically it's convexity or not. That's probably somewhat debatable, but let's call it convexity here. You need that convexity of returns on the upside. And this is where I think many investors can learn a lot from venture capital with their mindset and how they think about it. And obviously the most famous one is the power law here. I think the first time I learned about it from fantastic book 0 to 1 by Peter Thiel. And then there is another fantastic book that I read 2 years ago, I believe, The Power Law by Sebastian Mallaby. This is the same author who wrote More Money Than God. I think I actually like The Power Law even better than like More Money Than God, but that's subjective assessment. So that's a fantastic book about many great venture capitalists. Now, I'm not saying that public market investors should become venture capitalists. It's a different game. And by the way, by the time that these days public companies become public, they are way past those early stages where venture can invest. But the overall concept, the meta idea, the meta thought here is that if you're investing where base rates may be against you, Number one, churn probability is somewhat more in your favor than the base rates. That's number one. So do some filtering, cutting, whatever. And second, you need that explosive upside, where if you hold that company for 10 years, for example, it has a shot at becoming 5-bagger or 10-bagger or pick whatever bagger will satisfy.
However many bags you want, you can have.
So yes. So I think that's another consequence of that framing.
All right. We're going to hard pivot. All right. Let's ask the ESPN first take question. You and I were talking the other day. We're talking about AI. Again, we're going to do a webinar with AlphaSense talking about using AI tools, using expert calls, which I think are, I don't want to spoil the webinar. I mean, I think over the past—
spoil the webinar a little bit.
Yeah, look, I just think over the past 18 months. Say again?
Don't, you can spoil the webinar a little bit. Don't do it too much,
well,
but you can spoil.
Look, I've talked to some investors who are a little bit older than me, a little bit older than you, and they're like, "Oh, I haven't used AI at all yet." And I'm like, "Okay, cool. Like you're basically an investor in 2005 who's like, oh yeah, I'm not using spreadsheets and email. Like it's so revolutionary to me, and it changes so much. And the expert calls, I just think it's the only way to not the only way, but it's such a useful process for so little upfront to like talk to people in the industry, get real insights and everything. So they really evolved. Anyway, we were talking about AI because I was saying some of this, and you told me, hey, I think AI over time is going to make markets— I don't want to put words in your mouth, but I believe you said make markets stupider. And in my interpretation, that meant less efficient / easier to generate alpha. And I kind of disagreed, but I don't want to put words in your mouth. So I'd love to just ask you, am I remembering this correctly? Did you think AI will make markets less efficient and kind of easier for active investors to outperform over the long term?
First of all, I don't believe I said stupider.
I think you said stupider. I think stupider wasn't correct.
I think I said dumb.
Dumber. Okay.
First of all, I think I would have said more stupid, not stupider, if I were to use that word. And I think I said dumb.
Okay, dumber. Let's go with dumber.
I think that's what I said. So I'm not sure whether it's consensus view right now among investors.
I would firm disagree, which is, I would firm disagree, and I would think your view is quite non-consensus, though I don't think it's completely out of consensus.
Okay, so let me talk about how I got to that thought. And also I want to caveat something. I'm not a coder. I'm not a software developer. My typical solution to any tech problem is to restart my computer. And if that doesn't work, plug it out of power for 30 seconds and then plug it back in.
Yeah.
Okay? So I want to be very, very clear about that. And I also want to say that, by the way, it applies to anything that I say, but here it's even more so. I could revise my view 6 months later, or 3 months later, or 12 months later, or even tomorrow. And I am not a futurist. I am not predicting the technological future. But this is my thought process. Where we started with you today is that investing is a craft. And it takes certain time to master that craft. The best way to master the craft, if you have a great mentor, you're working directly in front of him, for him or her, and you're learning and copying that. That's probably the best. If you didn't have that opportunity, maybe you figure out it yourself. You probably spend more time figuring it out on your own, and you probably got more scars on your back from your mistakes, etc., that sometimes was self-inflicted. But that's how you arrive to a process of insight generation and getting to conclusions. And in order to make strong returns, you need to arrive into some insights into the business, into the investment setup, into something else that are usually fail and non-obvious. And I think there is a danger. I'm not saying it will happen. I'm saying it might happen. Going back to our conversation about Bitcoin, it's one of those future states of the world. It doesn't mean that it will be the state where people, especially younger generation of investors, they will outsource their thinking to AI. I would suspect that your parents and my parents' generation, on average, and on average is the key word here, are better at navigating a city without a GPS. I expect that our generation are worse. I also suspect that those who are now 25 are probably even worse than us at that. It's a skill of atrophy. And if I mispronounce that, you will need to correct me. So that muscle is just goes away for people because it's so easy to plug your GPS. And I think there is a real danger that may happen with how people think, how people do research, and how people develop conviction in investing. And AI is an incredibly powerful tool. There is no doubt about that. Everybody says that. That's not insightful. But what it will do to our brains is an open question. And I think those people who can figure out how, as the AI stands today, and remember, it can evolve, it can get a lot better, it can do something else that we can even think about right now. But as the AI stands today in early August 2025, I think people who will succeed, who are more likely to succeed, are the people who figure out how to use AI as a supplement and who do not fall intentionally or unintentionally into the trap of outsourcing their thought process to AI.
Also,
and also something else. You said more, you interpreted my point as more efficient. I think market efficiency or efficient markets, it's such a loaded term that everybody means something different that I would rather not use it.
Okay.
What I think might happen is that market will become more consensus because people will be asking roughly the same questions to roughly the same large language models. Now, there will be some variation in their prompting skills and variation in a particular model that they're using. Some of them is better at any single moment in time because there is a race between them. Sure, there will be some variability. But I think the answer that will be given will be fairly similar, big picture. And what it means, I think market will become more consensus. And if you figure out where AI is missing either important data points or information is just not out there, meaning it has not been written on the internet, in articles, in expert calls, somewhere else, your opportunity to generate outsized returns, because everybody else is running left and you realize that you need to be running right, I think will likely improve. That's what I meant by dumb and dumb. Maybe it's too strong of a word, but it will be more consensus driven.
So, honestly, as you described it, I kind of don't know if I've got huge disagreements here with you. And I'd kind of analogize like this. Like, I like to say, hey, if somebody comes to me right now with a PE multiple based investment, right? They say, hey, Andrew, stock XYZ is trading at 8 times price to earnings. I think it's a buy. I'd be like, cool. Like, there's no alpha there. You've just bought beta and probably negative beta, right? Because 50 years ago, 60 years ago, there was alpha there. There were not computers that were doing that. You could go kind of calculate that and buy something. About 20 years ago, 25 years ago, like computers got so good, they were automatically doing that and it was kind of priced in. But what that meant was in, let's call it 2010, that got priced in and the returns to finding things that were non-obvious values. And I would think about many of the compounders you talked about, right? Figure out early, Google, Facebook, all these sort of stuff. Amazon, yes, they did not trade for 10 times earnings, so they weren't your traditional value, but they had this huge growth runway, huge moats, lots of ability to compound. And, for many of them, I don't think Amazon was guaranteed, but like Facebook and Google, once they kind of locked in, especially Google, it was kind of guaranteed that they were going to grow and continue taking share. If you could figure that out and you could invest beyond, Google trades at 25 times next year's earnings, and you could kind of see the growth runway and the unit economics, you could make a fortune. And I think what you're saying is, hey, AI is going to price out maybe a lot of the medium-term insights, right? Like AI is going to have a lot of insights. Maybe it's going to price out the alpha in buying the compounders and buying the unit economics. But if you can figure out like something that is beyond that, the returns to that, buying Google was exponentially better if you figured out that insight than buying US Steel at 4 times price earnings in the 80s was. If you can figure out kind of the next insight, that AI is not going to generate something that we can talk about what it would have to be. The returns to that actually might be exponentially better. Am I saying that and summarizing that correctly?
I wouldn't call it I wouldn't say that you're summarizing. I would say that you are putting another angle on this issue.
Okay.
And some elements I think are fair, some elements I don't know. I don't have a strong answer. Whether AI will be pricing out medium-term alpha versus long-term alpha, I don't know. I don't have an answer. I don't think I'm prepared to figure out an answer right now. As time passes by, we may figure out. If you were to ask me now, I would probably say that I think it will be more dispersed. I think it will be more consensus-driven. That's kind of how I think about it. Because if AI will be giving same answers, roughly again the same, to a bunch of analysts, and by the way, get an answer from AI, in my opinion, is very different than reading 15 earnings calls or conference transcripts, or listening them live if you prefer listening, and reading, or better yet, conducting yourself tons of expert calls, and getting slowly to that mosaic and putting it together. I think it's very, very different from the way you, in terms of process, how you get to that conviction and knowledge, deep knowledge ingrained in you, versus reading a 30 or 40 or 50 page output from AI, which can be useful in certain cases, but it should not replace your brains and thinking. And then feeling that I have this knowledge. I call it fake knowledge. Like, you don't. Maybe you memorized it, maybe you didn't, depending on your quality of your memory and its capacity. But it's not the same as figuring out those things yourself. So that's how I think about that. What I think AI will probably do is that different competitive advantages, or competitive strengths would be a better term, that people have, may become obsolete, and then you need to reinvent yourself and figure out your new competitive strengths. I'll give you an example. If someone was really good at writing 10 years ago, you're just like brilliant writer. You're engaging, you're convincing, you can figure out how to deliver insights and punchlines. That's a fantastic skill. Not everybody can do it. Guess what? Now, you still may be better than everybody else, but everybody else with the AI, the gap between you and everybody else who is average with the AI has closed dramatically. And I think it's overall theme, by the way, of technology and technology-based investment tools, research tools, including AI, including expert library, including expert calls, is overall democratization of access to information and knowledge. And also, I believe, closing the gap between investment firms or investors in general with different financial resources. In other words, hypothetically, let's pick expert library tools, for example. If 10 years ago, before expert libraries came out, expert call libraries, and this is all hypothetical measurements, a person at $2 billion fund has 100 units of utility because they could access someone like bespoke expert calls and pay $1,000 to a provider. Yes. That's very expensive. Now, if you're a $2 billion fund, you have the budget. You're fine. If you're a $5 million fund, for example, I'm intentionally taking something very, very small, you couldn't afford it. You're out. Then with Tigu's advent, and then Stream, and now it's all under AlphaSense umbrella, you can be subscribed, you can have access to a bunch of to a library. You can do your own bespoke calls at a lot cheaper price.
Yes.
That democratization of access to information, knowledge, and insights. That's fantastic. So I think now, if before the gap between a small fund and a very big fund was 100 units or 99 units, gap still exists, don't get me wrong, but now it's maybe 20 or 30. It's a lot smaller. And I think AI is likely to do the same.
No, so I think that's interesting, because what you're saying is like one area, again, 30 years ago, 50, probably more than 30, but 40, 50 years ago, your edge could be, I can calculate price to earnings, right? Like your edge was basically, I can do math better. Yes. And that gets arbitraged away by a lot of things. Quant fund, first Excel, so everybody kind of gets it, and then quant funds start running and automatically applying it. I think what you're saying is, hey, the past 10 to 15 years, one of the areas of edge might have been, I can ingest information either more or better, right? As you said with the big funds, and you're 100% right. A big fund now, but especially 10 years ago, could afford to go do 10 expert calls and throw down $10,000 of research expense on a position, whereas a small fund just couldn't do that. With expert libraries, that's moving away from AI, but a big fund might have had 5 analysts who could summarize every sell side note, every expert call, all that. That AI can do that for a small fund now. So that summary of information goes away. The new tools is like the question is going forward, what is the thing that will kind of get amplified by AI? And I think I've talked and written about this. And I mean, in my view, and you can tell me if you disagree or if I'm completely misinterpreting the premise. Like in my view, as that kind of ability to summarize big things of information gets consumed by AI, and maybe simple theses get spit out by AI, I think the next wave is kind of, hey, can you go find me things that are not on the internet or that are not publicly available? And obviously, I'm not talking about MNPI, but I'm talking about, hey, the next wave might be you're researching a retail company. Like, can you find non-obvious sources of data? Or you're researching a lumber company. Are you the person who can go and go to a lumber conference and network with 15 people at the lumber conference? So you've got a read on how everything's going that literally no one else has because it's bespoke. You created it yourself. I don't know. Do you agree, disagree there?
I think we are looking in the same direction. I agree. I will add a couple of examples or wrinkles or nuances. By the way, wrinkle is an interesting word. We can speak about it in a second. So I think I unintentionally created a pun here, even though I didn't think about it before I said it out.
Wait, say it again. My wife is so much better with puns and wordplay than me that what's the pun?
No, I remember I said there may be a couple of other wrinkles on what you said. And then I realized that my example is actually fits nicely into wrinkles.
Okay.
So this is big picture. I agree with what you said. I think situations where information does not exist in written form at all, that's one of the areas where it will be fascinating. And I think what will and also let's step back. And as you know, mostly Caro-Kann Capital, the fund that I run, invests in small and micro cap securities. Not exclusively, but that's what mostly I do. This is where I spend most of my time. So what it means? It means that general, if you go into, let's say, AlphaSense Expert Call Library or TIGUS, and again, I will use them interchangeably because they're in the process of converging the two. If you go there and you pick $20 billion market cap company, probably there will be, I don't know, a few dozens of calls, right? That's probably pretty reasonable, especially if you pick, let's say, TMT that are more popular among investors to do expert calls, etc. There will be a lot. My ideal setup, I go to the expert call library, I put the ticker in, and it gives me, there are no expert calls available. Would you like to request one? Or maybe it's one or two. And ideally also it's kind of old. In that case, if someone goes and says, and let's pick a real company, disclosure, the company that I'm going to mention, Caro-Kann Capital, LLC, and or its affiliates own shares of SoftWave listed in Israel. So, and by the way, that's the company that sells medical devices for skin tightening, has a recurring revenue business model, razor blade, and one of the consequences, if you are a patient using that, you remove wrinkles. So that's why I was.
There's the pun. Okay, now I do. Yeah.
Which I said absolutely accidental, and then I should use this as an example. When I learned about company's existence first and started doing research, there was only one expert call on AlphaSense. That's the call library that I use. Only one, not many. And by the way, it was somewhat negative, in my opinion. Or at least it was pointing out areas where the company needs to improve itself. And by the way, in my opinion, by the time when I read the call, I thought they'd already fixed all those things that the former employee was mentioning. So I felt like, okay, I guess probably they were reasonable concerns, but as the company has grown, they fixed it, fine. But that's all. So, okay. And remember, this company listed in Israel, financials are in Hebrew. I don't speak Hebrew, unfortunately. how are you going to be interacting with AI in that situation? One expert call, filings, and sure, different titles will be happily translating those filings for you. In fact, I use them for that. But it's very different to interact with AI tool in that case. There is no information. Large language model needs to have language to give you answers, something in writing. As part of my work, I've done multiple expert calls. I spoke with patients. Patients I spoke anecdotally. That's not expert calls. But I spoke with doctors who are the people buying the product, and then they will be engaging with patients, explain them the benefits of the treatment, and using those devices. And I spoke also with former employees, showing them about the company culture and market, sales process, everything what you will be asking. If you now go into library and put software as a ticket, you probably will get what? By now, 8, 9 expert calls will be my guess, roughly. At this point in time, you can use AI to ask thoughtful questions. Now, you also need to have thoughtful questions, so you need to have an investment process. AI will not replace your investment process. If you have a good investment process, AI will make it more robust. If your investment process is not robust, or you don't have a good process at all, then AI will make things even worse. That's my subjective opinion. So now you can go interact with AI, ask questions, and you will get to those takeaways, conclusions, insights, punchlines a lot faster. What I think it means are original ideas with very little information in writing, and information will mostly qualitative, of course, will be more important to find early. But then what I think will happen, the discovery period of those ideas and market repricing those ideas will probably shorten.
Well, look, I think what you described fits into my thing, right? Like, I was talking about finding non-standard places of information. And in my head, I was kind of thinking like a $2 billion company where you go and you get cut checks at an industry conference or something that obviously aren't it. What you described was finding a company that was small enough that there wasn't much information out there. And you went, and by doing the, in this case, expert calls and customer talks and everything, you created the information for yourself, right? Now, that doesn't mean it's a good and bad investment, but if you have 100 companies with not a lot out there, you go create that all. And eventually, if you're using a public expert call transcript, in this case, it goes public eventually, but you create all the data and then you feed it in. You do have edge because you created it. Now, hopefully you can create that data and kind of refine it and execute on it properly, right? Like that. I certainly know there have been some undiscovered microcaps that I've invested in that, I thought I had edge on, and I kind of wish they had gone undiscovered by me in the long run. But you are kind of describing describing the same thing, creating information and having the data, having an information edge there. Let's talk more about expert calls in our follow-up interview tomorrow, which again, I'll include a link in the show note. I want to ask you something, since this is supposed to be a process-themed process. I think about process all the time. I'd love to ask you, what is something 10 years that you've done over the past 10 years? I'm late 30s, you're early 40s. Theoretically, we both should actually be hitting kind of the peaks of our investing careers, right around now. What is something that you did 10 years ago as you were kind of prepping for the prime of your career, is the generous way I put it, that you've changed, that you've improved on, anything that you think has made a noticeable difference in your investing process?
Massively bigger focus on the customer.
So massively bigger focus, more focus on the company's customers is
correct.
What? Okay. And let's just give me an example.
Early on, when I was running Caro-Kann, I made a very painful investment mistake in a company invested in a company called AgroFresh.
I know AgroFresh.
It was a significant loser. I think you and I spoke about that. So back in 2015, and with the full benefit of hindsight, if I spoken with a few customers, I think I would have probably realized that while customers value the product, there is a difference between customers, satisfied customers, and raving fans. Ideally, you want to be invested in companies who serve a constituency, and that constituency are raving fans. And I think I could have done a substantially better job and avoided a painful mistake, both psychological and P&L, if I applied that framework to understanding AgroFresh. I could have done a lot better. Now, what it led me to is I need to understand customer value proposition better. And guess what? What's the best way to understand customer value proposition? Talk to customers. Ideally, if you could visit them, right, spend time with them. But sometimes it's an intangible product, so you can speak with them and learn about why they consume it, etc., etc. And this is, by the way, I think doing expert calls is very, very valuable. Understanding that customer value proposition and why customers are not switching, what the competing solutions, what the buying process, etc., etc. Who is the decision maker within the customer organization if it's B2B product, then you need to understand all those things. And the old school way would be ask your network. Now, that's the best because you will get unfiltered answers. But I have a reasonably large network of people from business school, from other venues of my life, etc., etc. But there are natural limits there. So you need to ask for introductions or introductions, etc., etc. If you could find someone like that, that's the best. But if you couldn't, then either go LinkedIn and start cold calling, fantastic, or use expert call providers. In the past, it was very expensive. The cost has gone down, as you and I discussed 5 minutes ago.
Let me ask a couple questions there. So I like that answer, I do, but as I said earlier, I want one rule, right? I want one rule to rule them all for everything I do. And one of the tough things I found with customer calls is two. Number one is, what's this? I think it was Steve Jobs. He said, like, the customer doesn't know what they want until we give it to them, right? And sometimes I can think of recent examples. I don't quite want to disclose the company, but I'm sure people can think of something similar. A company is launching a product, right? And it's an improvement on the current product, but word gets out and people know. And I talk to the customers and they say, oh, whatever. We don't really need that product. We don't think it's that much better. We're not going to upgrade, whatever. And then the product comes out. These are generally B2B products, but exceptions. The product comes out, and then you talk to the same customers 2 weeks later, and they're like, "We love it. We're upgrading all of our equipment to it," like that type of stuff. So that is one thing I worry about, where the customer, like, they can be so fickle. And obviously they were talking about something that's yet to be launched versus launched, but they can be so fickle with that. I kind of worry that I talk to them and I have one opinion, and then the next week, if I talk to them, I'd have a completely different opinion.
Do you want to pause the recording, rewind to the place where we spoke with you about base rates and how you're trying to recut the universe and how you're figuring out that you're betting on outliers? So this is my response to you. Like, I want one rule answer.
I know.
Andrew, this is my one rule answer to you. There are no one rule answers at all. That will be my response. Look, at the end of the day, what we as managers are getting paid for is judgments and decision-making. Everything else, talking to management, attending investor conference, attending industry events, talking to former employees, searching the web, talking to AI, reading, modeling, whatever you do, that's simply an input. It simply feeds to the output, and the output is your decision, your judgment, and decisions are based on judgments. So I think what you're saying is this: how can I make the same judgment all the time in similar set of circumstances and be right? And the answer is, I don't think you can. And it boils down to, and also remember, it's a lot about nuances or wrinkles. In your example, you started with Steve Jobs' famous quote. First of all, it's about B2C. Second of all, it's about the true breakthrough disruptive innovation, where the product does not exist. I don't think that question is it's unknown and unknowable. You wouldn't know whether that product will take off with customers or not. And by the way, if you had an insight that this product will be fantastic, even when iPod came out, you would have been probably calling me right now from your BBJ, from your own private island.
No, let me give you the other side of it. I know, yeah.
So that's B2C, and that's unknown and unknowable. And then there is another end of the spectrum where products are already there. It's a B2B software company. Let's pick HubSpot. I don't own HubSpot. I admire the business and what they've done and what they've built, etc. If a number of years ago you spoke with 20 customers using HubSpot, you will probably figure out that it's a very, very good CRM, MarTech, marketing technology, SaaS company. And you would have probably figured out that the product is good and customers are satisfied and they're happy and maybe they're even more than satisfied. So that's a very different thing than talking to them about if you get this product that doesn't exist, but it has this feature, it's very different. So I think you need to calibrate the tools that you're using. Do you play golf?
I did when I was a kid, but right now, no.
Okay, fantastic. So
I know the rules just fine. Yeah.
Okay, so I don't play golf either. So that's why I will give you an analogy from golf, because I have no idea how to play it. So in golf, as far as I understand, there are very many different types of cups, right?
I cannot believe you're giving an analogy from a sport you don't play.
Okay.
There is, yes.
And depending on the terrain, depending on the circumstances, wind, whatever, you are using a different cup for each situation. I think with your approach, you have one size answer to all situations. You're trying to go to play golf tournament, and you brought only one cup.
You are correct.
Not work. You have all of them, and you need to figure out which one to use when.
I can't believe how good of an analogy you just used with a sport that you don't play or apparently know the rules to, because that was excellent.
So now, okay, I'm going to hear that, because otherwise it will be very embarrassing if I give you an analogy that was totally be misplaced.
Let me go to a completely different question.
Okay.
One thing, you and I talk quite a bit. I think people can probably hear that. You and I probably talk quite a bit to, the small cap value investor fund community is not large. We probably talk quite a bit to the same people. There are a couple stocks that, if you go read, if there are 20 small cap value investors, you go read 20 of the letters, 12 of the 20 managers are long the same one stock, right? I don't need to name names, but I'm sure everyone, as soon as I said this, who follows the markets closely can think of something. And guess what? It doesn't just apply to small cap managers, right? Like Bill Ackman for a long time, he'd go long a stock, and then, all of a sudden there's 15 other people who run like medium to large size hedge funds who are long the same stock. Like it happens. Tiger Club alumni. Oh, look, one of them's long, all of them are long. Like it happens. You talk to smart people, you share diligence, you all come. That's great. Hopefully you're talking to really smart investors who have really thoughtful theses and stuff. But one thing I always worry about is it is very easy to start outsourcing conviction, outsourcing thought. It's very easy to get into groupthink. It's very easy to get into the same names. And even if you gave me one thing I worry about, and I know you mentioned SoftWave, and I have looked at this chart recently, and I'm kicking myself. You and I talked about it quite a bit, and there was med device issues, and I can talk about those later. But one thing I always worry about, I feel like I have a higher bar for when a friend brings me a name, because I'm worried that because I respect them, I will have a lower bar for it and groupthink. And then I'll just call them up after every quarter and say, hey, what you think? And then kind of rely on that. So I just want to ask you, I'm running Yet Another Value podcast, 330 episodes, 315 of them are individual stock pitches, right? When a listener listens to this and they love an idea, and obviously nothing investing by, but they love an idea. When you and I talk, when you talk to other friends, how do you kind of like dial back and avoid the groupthink, avoid the, hey, I'm outsourced thinking, hey, this person has biased me in an investment, even if you're kind of going to like run the bases and do all the work on it? How do you avoid somebody you respect telling you they've put their money behind it, they've put their belief behind it, and that's not going to influence you?
So first of all, when you hit your 400 podcasts, we got to do another interview where I come and interview you. I promised to wear Yet Another Value polo that you kindly gave me. So
there we go.
Another interview, it will be the second. Remember, we did after 210.
We did. And on this one, you're going to show off the Yet Another Value podcast tattoo that you got as well, right?
Oh, yeah. Yeah, no, I would not. So, but I can show a bottle. I can show a bottle. It's very, by the way, very nice bottle, great size. So, the one line answer will be, in the situation that you described, I want to make the conviction my own. Don't outsource conviction, that's a dumb idea, but make idea your own. There are some ideas in my portfolio that I probably got from a peer friend whom I like and respect their thought process, but by now I may know some of those ideas, not all of them, but I will know some of those ideas better than they do. And even if they still all know it better because they've spent longer time researching the company, etc., I have my own conviction in those. So that's, I think, what we need to be aspiring to. So that's number one. Number two, you remember you said lower bar, right? I don't think it's the right way to frame it. Low bar to invest in an idea because it came from a friend, especially if you like a friend. So I think the low bar should be applied if idea comes from a friend or respected peer to put that idea on top of your research pipeline. There are some friends in my network whom, if they call me today and say, Artem, I have a great idea. Let me tell you about it. I'm so excited. This is an idea. I'll probably drop almost everything and we'll start researching that idea. I will not go and buy it, but I will go and start researching. It will trump over a bunch of other ideas that I have in my pipeline that I sourced myself or already I got from someone else, etc. So I have a lower bar there, but my bar to invest should be the same. That's what I aspire to. I am a human being. I'm fallible. There are probably cases where I did not execute to that vision that I just described, and maybe I did lower the investment bar. It's possible. But that's my aspiration. That's what I force myself to do. And the way you force yourself to do it is via following your own investment process. If your investment process is, for example, to read 3 years of all earnings calls and conference presentations, do not shortcut it just because idea came from a friend whom you like and respect. Go and do it. And again, I'm using kind of very simplistic, very crude tools. If your rule of investment process, read 5 customer expert calls or do your own if they're not available. And by the way, 5 is a pretty low threshold, by the way, especially if there are 20 in the database. It's a pretty low threshold, or 30 or 50. So you go and do the same number of calls that you always do. Either your own bespoke, if that's your process, or if you're okay with reading someone else's calls, fine, go do it. You don't cut it. If your process talk to management and ask them your questions that are on top of your mind, etc., etc., do not cut that step out just because idea came from a person who you deeply respect. So, and again, it's one thing to say, I want to have the same level of conviction as I do on my own ideas. Sure, but the way you get it done is by your processes and your routines. That's how you get it done. So, and then also, this is very important, about ideas coming from your network. I have friends. I'll use myself as an example. If I call you, Andrew, and say, Andrew, I got a great idea for you. First of all, I hope you will pick up the phone. So,
no, I'm saying I'll call you when I'm walking Penny. I'm with Sylvie. I'll call you when I'm walking Penny.
So if I call you and say, Andrew, I found this company. It has $200 million market cap. It's listed, pick a country where most people don't look at. And there is no sell-side coverage. And there are no Value Investors Club write-ups. Or maybe there is one, but very little information. And there are no expert calls and blah, 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 blah. I would suggest that you listen to me carefully and thoughtfully, and maybe put that idea on top of your research pile. If I call you and say, Andrew, I found this great investment setup. It's a coal company on the East Coast, trading at 4 times earnings, but they're going to pay a big special dividend. I think you should hang up on me. Why? I don't think I know how to do those investment situations. That's not my core strengths. And most likely what I'm calling you about is a pretty lousy idea. And I don't think you should.
Funny you said special dividend. I was like, I'm here for it, Artem. What's the company?
I know, but remember, I usually don't call you with this type of ideas. So you need to calibrate when an investor friend mentions an idea, you need to calibrate whether that's a place. Imagine a hypothetical investor with a very strong track record, okay? But you need to figure out, in my opinion, I want to figure out where those returns came from, what type of patterns and situations. If those ideas came from cold names trading 3 or 4 times earnings, returning capital, doing buyback or doing a tender or whatever, I won't probably listen to that person when he pitches those ideas. If that person made money on software as a service names, so software as a service companies that are 1 to 2 billion market cap and they're about to become $5 or $10 billion company in the next few years, I want to listen to those ideas from another person. So I think that calibration is very, very, very important.
No, that's super interesting, especially because there's a company you and I've been talking about that fits one of the descriptions, and it just rips fire in my face every day. And I'm like, neither. One of the great things about being podcast host is I can ask completely simple questions under the guise of asking for my listeners. So I want to end with one question that has really been on my mind recently. In terms of process improvement, we've talked a lot about ideas and stuff, but in terms of sizing, force ranking, however you do it, your ideas, how has that changed for you over time?
That's a process, and it's a difficult one. And it's a difficult one because you would never get everything perfectly right. And that's difficult. So, and this is just psychologically challenging. And we know this. I don't know whether people who listen to this will know this or not about me. In my prior professional life, I was an international tax lawyer in New York working for a big American law firm. So think about this. I'm an associate. I'm getting an assignment from a partner, research certain situation. Let's say, our client wants to do a tax-free spin-off.
Yes.
Do we have the facts that will support tax-free treatment, et cetera, et cetera? We need to do analysis, as an example, right? So if I come back to a partner and say, hey, this is my legal memorandum, I wrote, let's say, 10-page memo, and that memo is about 60% accurate. I think the tax partner should take me and kick me out from the 38th floor of 200 Park Avenue. That was our office was. And they would be right for doing so. Now, they're very nice people. I hope they wouldn't, but you see my punchline. If you're right 60% of the time in your force ranking your positions or managing your portfolio on your expected IRR, you're probably doing pretty well. And that's a very challenging mindset for anybody. That's why I think people, for example, who play a lot of probabilistic games and come to investing, they may have a natural psychological edge because they're used to that, like playing poker. They're used to that. They may have a good hand and they might still lose it. So that's very different mindset. And for me personally, it has been a challenge to adjust since the time I left legal profession, went to Stanford Business School, then worked for another hedge fund, then started Caro-Kann Capital. That's not easy psychologically. So what I'm going to tell you is that it doesn't mean that I have the perfect answers, and it doesn't mean that I get it right, and it's work in progress. So I think I've become more mindful of looking more carefully at the expected IRRs. And I cannot say that I've never done it. It's more about doing it in a more systemic way and comparing them. But it's still very, very tough.
So expected IRRs is an interesting one because I was talking about this with someone the other day. I've gone back and forth so many times on it. My issue with expected IRRs is what I have found is when you do it by expected IRRs, and there are other ways to modify this, but it would push me to be into the most levered stuff out there because the most leveraged stuff is what gives you the highest upside, right? And that could be the correct answer, right? Like Todd Weschler, who is one of Berkshire's portfolio manager, everybody talks about his IRA, right? His IRA was 2 or 3 bets, super levered companies that survived and went up 100x, right? So it's possible that we should be taking advantage of the convexity of non-recourse leverage in the stock market by buying companies that are super levered, right? But what I was finding was when I would do a forced ranking by IRR, and I mean, at some point I would cover like 50 companies and I would do like literal, hey, here's my fair value. Like I sound like a sell side analyst. Here's my fair value. Here's where the stock is, what trades at the biggest discrepancy. And what I noticed is, oh crap, all of a sudden my portfolio is just the most levered companies I follow in general, right? So that's why I've gone back and forth on IRR. And then I had somebody say, hey, well, charge yourself a volatility factor, right? Or you can do it on an unlevered basis, right? Judge everything on judge everything on an EV basis and how much it trades on discounts of the EV. But when you go that route, what do you end up with? You end up, for the most part, investing in companies that have huge net cash balances, right? So you've got almost no beta on the upside because yes, they trade, their EV is 50, they're trading for 25, but it's all net cash and you're just kind of waiting for the cash to be returned. So I've just gone back and forth one so much. Go ahead, please.
Okay. You want one size answer, as you and
I know, but yeah, I'm also just discussing and being a very handsome podcast host.
Oh, absolutely. So look, first of all, stylistically, I think you and I were we stylistically diverge the most, like philosophically. I do not like levered companies. And remember, you and I were running informal, no recording book club that we need to resume doing. And we're discussing a particular book, one chapter per conversation. And our biggest disagreement on one of the chapters was, do not invest in levered companies.
Yep.
And for me, that was very natural. Like, yep, I subscribe to that view. I rarely invest in levered companies.
And I put the book down and never read it again.
Huh?
I put the book down and never read it again.
You're like, that's nonsense, right? So you and I disagree on this philosophically, and that's totally fine. Now, if you're investing on levered companies, or you invest in a number of them in your portfolio, yes, you can, if you rank them all purely on expected IRR, you will end up indeed with having all those levered names at the top of the list. What I would encourage, but what is interesting to me is that you said, okay, then I try to do it on volatility. But then I end up with a bunch of companies that have very little EV because they have too much cash.
The volatility was you charge a volatility factor to account for that. And I struggle with that. So then I switched to EV and then you just get a bunch of net cash companies.
Yeah.
So, yeah.
And I think this, if I were you, if you hired me as your portfolio management coach, by the way, I don't think you should, but if you were to make that dumb decision, in that case, I would say, Andrew, you need to apply a penalizing factor to those. You will have simplistically 2 variable ranking system. One would be expected IRR, but then you need to add another one that will account, and now I will show the quotes, risk. Risk, I'm not talking about volatility here. Sure. I'm talking about the company going bust.
When I said volatility, I did kind of mean risk. I wasn't talking about stock market volatility, but please continue.
Okay, so and then you would be applying most likely fairly significant penalizing factor or downward adjustment because it's a levered company. If you tell me, Artem, I have 2 stocks, I only imagine the world, like now we'll play microeconomics 101. There's product A and product B. That's all. There are no other products in microeconomics 101. So there are only 2 stocks, stock A and stock B. Based on your math, and let's assume that you have really good math and really good estimates and everything, 25% IRR over the 3-year holding period on each of them. I will say, fantastic, Andrew, what's the name? Well, give me a call. I want to know the thesis. So, but then I will tell you, one of them, you tell me, has 0 debt. Another one has, so let's say 6 times EBITDA, 4 times of debt, and 2 times of equity. I will say that these 2 opportunities are not born equal.
Yep.
Right now, I don't know exact portfolio. I don't know all those variables, but I think you need to force that and apply some kind of borderline common sense that here IRRs show my math, my Excel, my master Excel file spits out the same IRRs, but they're not born equal. And then you adjust for that. For me, it's probably a little bit easier because I don't invest in as many levered companies. But I have other issues sometimes. For example, a few months ago, you and I were discussing, and then I think you mentioned this in one of your ramblings without naming me, which I appreciate the anonymity. But at some point, I think you and I chatted about, do we as investors take upon ourselves and our portfolios certain level of existential risks and whether we're properly pricing them? And that's a fascinating question because it can be 3% probability of something really, really, really negative happening. Like, imagine if you were selling product X and then that product got outlawed by the entire nation.
Yeah.
That's a big problem. You all of a sudden go out of business, right? I'm taking intentional an extreme case.
Extreme case that has happened, right?
Huh?
An extreme case that happens. I mean, this does happen. There are companies who have their products literally banned.
Yeah, it will happen, right? So, or imagine if you were investing in a natural resource company. By the way, I don't do that in an emerging market country with not very stable government and not very stable political regime that may not necessarily respect bilateral investment treaty.
Yeah.
And you may own the best, I'm making this up, okay? The best copper mine in country X. And then one day you wake up, there is a military coup in that country. And now the new leader, in his ultimate wisdom, believes that they now should be running that company instead of your company that is listed in New York.
Doesn't even have to be a copper mine. I've said, I think I did a rambling on the podcast, things that you say no to. And Chinese companies, I've really struggled with because I've never been to China. So the culture and like, there's so much more online is difficult. But B, I just keep thinking of like the Alibaba Ant Financial, like, hey, it belonged to Alibaba and then it did not. And like, how do you account for the 2% risk, whatever the risk is of the government, just forget the VIE structure and all the rest, the government just deciding, hey, this company, your assets now belong to us, right? Like it has happened in China, and I'm just not sure how to account for that risk.
Andrew, what I can tell you is that you are welcome to go to China with me. I'll take you there. And
the second kid is on the way, but you're not been planning a trip. Maybe after the second kid's a little older, and Alicia won't throw me out if I'm leaving her around for a 10-day trip over to China.
Like as you know, I've been to China many times. I speak some Mandarin. My son speaks massively better Mandarin now, so he fixes my mistakes when I say something incorrectly, which is hilarious. So yeah, I can take you there.
I appreciate it. It's going to take the Chinese stuff off my note list. It's going to add so much more to my research process. Okay. Anyway, did you want to have any concluding thoughts here? Because we're running pretty long. We're going to, I'll say what we're going to do next, but any concluding thoughts on that or anything else we've talked about today?
So going back to what we discussed briefly, I want to ask you, remember when you spoke about borrowing, the risk of relying on someone else's conviction and as a result making an investment mistake? And you spoke about there is a relatively small community of, call it, small cap managers.
Yeah.
How many are out there, you think? What's the TAM in units?
It's tough because there are bolt-ons. There, like, everyone's doing it a little bit differently, but I mean, I think there's a core group of like 50 people who have similar investment styles, which I would say is, for the most part, but not always, GARPy, undervalued, sub-billion dollars, let's call it. And then there are people who like are alongside the edge of it, who might go much smaller, much more illiquid, or might have more like kind of me with maybe a more of an event or eventy angle to it is what they focus on. But I'd say probably 50 are like the core. And I think everybody like reads their letters and everybody talks to them, and all of us like catch up with each other once every 3 or 6 or 9 months, and like maybe sees each other at the Berkshire meeting or something. But that's kind of what I would say.
Okay, I got a question. United States of America has about 330 million people, the population, roughly. Do you think that the entire nation, and let's forget about our peers who may be based in the United Kingdom, maybe they're based in Asia, they may be based in Singapore, Hong Kong, continental Europe, there are many places in America, there are many wonderful investors there. So, but let's even put those aside for now. Do you really think that the entire nation of 330 million Americans has only about 50 people, 50, who do small cap investing in the way?
No. This was small cap fund managers running similar styles who are chatting with each other. I think there are much more.
Okay, what fascinates me is this, and I don't know the answer. Maybe there are not 50 people like this. Maybe there are another few hundred people with somewhat similar style, but they're just not chatting very much with this 50 who you and I know. I don't know the answer. I'm genuinely curious. And by the way, so since okay, let me do a plug for myself. If you're a small manager, small meaning not your size of AUM necessarily, but in terms of where you invest, like small, micro, even small to mid cap, and we don't know each other, like reach out to me on LinkedIn, and you can send me a DM.
How dare you? That's what my podcast is for. Reach out to me, pop on the podcast.
No, reach out to Andrew and then reach out to me too, because I would like to meet other people in the space. Especially what is interesting, Andrew, is this, as you mentioned, you're kind of mid-30s and early 40s. So what I think is interesting, there is a new generation of investors who are now, I don't know, mid-20s, very early 30s, who are doing what you and I started doing, let's say, roughly 10 years ago, plus minus a couple of years. But there's this new generation. I know some of them. I don't know many of them. I would love to get to know them. They're younger. They are viewing the world differently. They have their own competitive strengths. They are different from ours. Their competitive strengths are different from our competitive strengths. So like I'm always very happy to meet those young investors. By the way, older too, but older I'm more likely to know because they probably have been in business longer. I probably met with them one way or another. But the younger guys and women, I don't necessarily know all of them. So I'd like to meet them, learn what they're doing, talk ideas, etc., etc.
Ditto. Always looking for young podcast guests and everything too. So cool. Artem, let's wrap it up here. I will just, again, you touched on expert calls a little bit. We touched on AI a decent bit, but we are going to do a webinar with the help of Tikas AlphaSense, really discussing how we're using expert calls and AI in our research process, investments, and everything. So I'll include a link to that in the show notes if anyone's kind of interested in diving further into those topics. In particular, I mean, look, I was going to say, in particular, expert calls have been a big focus of mine recently, but actually both. I mean, I'm spending so much time using different AI tools and stuff, and like, I've got so many things I want to talk with you about there, but we're running super long. So Artem Fokin, maybe my favorite guest overall. I can't think of anyone off the top of my head who's favorite. One of the most popular guests. Thank you so much for coming on. I'm looking forward to the webinar, including the link. Artem's got one more thing. Yes. There's always one more thing with Artem. Go ahead.
As you know, with me, I think it was Burford number 2, number 3 podcast when we were trying to desperately wrap up the podcast. I was like, Andrew, one more point. Okay, so one more point on this one. I think is the last one. Yeah. When you say, you're spending more time on expert calls and thinking about the best way of doing them, etc., but you're also thinking about AI a lot. And I think the interesting thing is this. I almost think that expert call libraries and AI is the match made in heaven.
Yes. Oh,
because LLM.
Don't spoil the webinar. Don't spoil the webinar.
But it's interesting. So because it's your fault you mentioned that, right? Yeah. So it's large language models. The language is the key word here. Where else, other than SEC filings, there is so much density in words? Well, like what else? So like they were kind of again, it's a perfect match. In my opinion.
You were the one who told me. I mean, this alone revolutionized a little bit of my research project. I hate to say what revolutionized because I don't think but it sped it up a lot. You know what I do now when I want to read an expert call? I mean, AlphaSense does have the summary at it, but what I've started doing, if I follow a company and it's got 5 expert calls, I toss all 5 into an LLM, say, summarize it for me, and then I summarize that. And then if I'm still interested in the company and want to learn a little bit more, then I go to the individual expert calls and read the summary there. And then if I'm still interested in like really want to dive in, then I go read the expert call itself. And by doing that, again, I give credit to you. You were the one, I believe, who told me this. By doing that, when I'm reading it, instead of like, when you read new information for the first time, it's actually very hard to process. But if I've kind of already read a summary, in that case, almost twice, I kind of know what's coming. And I can really parse the language and I really understand. And I found my retention and my absorptions much better. So, I mean, that is just one way. It is so perfect, but it's been an incredible tool for marrying expert calls and AI together.
Appreciate you giving me the credit. That's true. I did tell you that in terms of how I was using AI in expert calls. Now, what I would say, and let's conclude there because I don't want to spoil too much about our second conversation, is this. This is the framework, which is very simple, and it's not mine. I learned about this framework from Paul Enright, who used to be a portfolio manager at Viking, and he did 2 fantastic podcasts, one with Ted Siders on capital allocators, another one is Invest Like the Best with Patrick O'Shaughnessy. I believe Patrick O'Shaughnessy podcast came out first. Both are fantastic. I probably listened to them 3 times each over the last couple of years. And Paul Enright there offered a simple, but in my opinion, incredibly effective framework. Digging, analyzing, deciding. And what I found when I think about my own uses of AI is where AI fits in this 3-stage framework: digging, analyzing, deciding, and where I can use more of it, where I can use very little of it, or maybe even zero of it. So, but let's pause here, because that's how I will be kind of framing.
Okay, great. Yes, this is a great pause. We're going to do the webinar links in the show notes talking about AI expert calls. But Artem, this is awesome. Again, I just wanted to come on and we talked about a bunch of stuff. I just wanted to come on and improve the process with you. And hopefully I've improved my process a little bit, helped you improve your process a little bit. And hopefully our listeners are going to improve their process a little bit from listening to this. So this was awesome. We'll talk soon, buddy. And we'll go from there.
Talk soon.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.